Yeah, so Trading 212 have done a change recently to the front page of the front investing page, I guess. And for my own sanity, I'm going to record this just this example for people to explain how money weighted return works. And Steve and I'll then quickly riff on why we like it as a metric and actually why we use it as well. I had a fancy spreadsheet for a long period of time that calculated all this for me. I've stopped using it because it was becoming over complex for me to keep going. But Steve keeps going with his, and it, like I said, very useful metric. Banging my head against the wall, having to type out every time. So here goes. Here's an explanation of how money weighted return works, and we're going to have to pretend just for a brief period of time that we are farmers. So the harvest in this example is going to represent your final investment value. The seeds, they're going to represent the money that you invest, and the planting time just represents the times that you invest. So that's your key, essentially. So money weighted rate of return is basically measuring how well your entire crop grows, and this considers both when you planted the seeds and how many you planted at each time. So why is planting time important? So seeds planted earlier in the season, they have more time to grow and mature, which obviously results in a hopefully a bigger harvest. But late bloomers and late planters, they still contribute. Seeds planted, might not grow as large, but they'll still add to your overall harvest. So in simple terms, money weighted rate of return tells you how successful your farming or investing was, considering both your timing and the amount you invested at different times. It's like judging your overall farming skills based on the entire harvest and not just on an individual plant's performance. So, look, if we connect this back to investing, early investments are like early planting. They have more time to grow, benefit from compounding, just like plants getting bigger, producing seeds themselves. This can also have a detrimental effect on performance if you get your decisions incorrect. So if the farmer was to plant out before the last frost, for example, that would have a detrimental effect on the harvest. So later investments, they're a bit like late planting. They'll still contribute to your money weighted return, but they might not have the same growth potential as early investments straight away. But the longer time goes on, they will start to add more and more weight to that return. So you won't understand the maths by just looking at the page, because it's not a case of just looking at the value it gives you and saying, oh, look, that's not 1% of my deposits and that doesn't match. It's really difficult to think of a scenario that I can match the calculation to that will really help you out. But you've got to try and imagine a weighted calculation where the longer time has passed and the longer time that some money has been in the portfolio, the heavier its weighting will be in the calculation. And obviously, the less time that money has been invested, the less weighting it has. So why would this be useful? I sense that would be your next question. So it's useful in a situation where you've bought £100 worth of a stock, and over the course of a year it goes to say £200, and that's 100% return for you. So you're pretty confident. So you think, right, I'm going to stick in another £200. I know what I'm doing here. So on a standard return calculation, if you had a share that shares that had gone to £200, you put £200 more in, that would drop you down to 50%, because that's just how the maths would work, because of the dilutive effect of your deposit. But in money weighted rate of return, it wouldn't, and the effect would be lessened, and it would still show 100% decision, obviously valuing that early decision you made, until further down the line when you see the effects of that extra addition over time. So when you do benchmark comparisons at the end of the year, you're going to get a much better reflection of the decisions you've made throughout the year without the dilutive effects of complicated comparisons. So the long and short of it is probably Trading 212 needs to have both. But I hope that helps you understand why that's a useful calculation. And just as a side note, I know not everybody uses pies, but if you were to pop your shares into a pie, on the investments tab on the front, so not actually in the pie itself, but in the investments tab itself, it does still currently show you your unrealized return in a percentage, and I believe in a value amount as well. So you can still have the best of both worlds. It's a little bit of a workaround, and I'm sure Trading 212 will eventually address the feedback and probably just stick a toggle to switch between the two. But I hope that helps you understand why money weighted rate of return is helpful. And Steve, have you got anything to add to that?
This stuff is essential for benchmarking, basically. If you're not money weighting returns properly, then your benchmarking isn't proper benchmarking, basically. And I think this makes it a lot easier for people working out their kind of returns. Similar example to kind of illustrate the same point then, for the moment. I mean, suppose then Steve and I give up on stocks and shares for the time being, and we both decide we're just going to lump our ISA deposits into an ISA every year. Steve whacked in 20 grand at the start of the year, and I whack mine in whatever it is, 1666 a month for 12 months. And the ISA, we use the same product and it pays 5% per year. At the end of the year, Steve's had his cash sat there all year, so he collects 5% in total, which is 1,000. My balance is lower than that because I've been adding it month by month, and I go off to the ISA provider and I say, "Oi, I put in 20,000, 5% of 20,000 is 1,000, you give me my 1,000." And they say, "No, because we've been paying you monthly based on what's in the account." In other words, they're factoring in the fact that I've been putting my cash in at different times. Have they not been giving me a 5% return? No, they absolutely have been giving me a 5% return, but where I've ended up is effectively a 5% return on what I put in at the time that I put it in there. This is kind of what's going on with money-weighted rates of return. It pays attention to, as Steve was saying, what you plant and when you plant it, and then looks backwards with your kind of return and says, okay, you put in this much at this point, so the amount you've managed back amounts to a 5%, 2%, 30%, whatever it is, return. That's, I guess, the way I think about these things. I think it's great. I think it's great because it saves me a spreadsheet now, basically, as long as they keep it where it is, and I'll be happy to keep reading it off the screen, to be honest, Steve.
Couple of areas that we would offer as feedback to Trading 212. It seems that when you click on the 1 day button, that seems to be doing 24 hours of calculation, where it's taking some of the day before. I don't think that's particularly useful when you're looking at 1 days. I think 1 day should pretty much be from 12, essentially from midnight onwards. I think the same thing of 7 days. It really should be from beginning of the week to where we are today. Same with month. It should be from the beginning of the month to where we are today. And then the year and the max can be whatever. Maybe even a 3-month one. Do we have a 3-month or 6 month? They may be handy as well. But really they come from the quarters. I think having them come from 20, like the 1 day coming from 24 hours, to me, Steve, that's a bit nonsensical. I think that just makes it harder for people to get their head around these kind of things, because they're looking at a day maybe where they were down 3% yesterday, and they're looking at today where it's gone up 2% immediately, and they're like, well, I can't be down that much, but it's because also the 24-hour period is time weighted as well. So the beginning of that calculation is more important than the end of it currently. So yeah, a little bit of confusion there, but I think with time, people will get to understand it, and I do understand the concern as well. I think having a simple return and a money weighted return solves everybody's problems, really, Steve. And I think that's probably, I would imagine, something Trading 212 will add back in the future.
Yep, I feel the same way, actually. I was initially, took a moment to get used to that on the day calculation. I usually have mine set to the 1 day thing, and I was watching my return kind of creeping and thought, is it doing that? And the reason isn't that the kind of number I'm at is moving, it's that the comparison period at the front end is rolling off, basically, and it's now comparing that to a further back thing. So it's a very good point that I would start that from kind of midnight and see what happens after that, which will be fine as long as we don't get into 24-hour trading, but let's not get ourselves back down that wormhole. A reminder for anyone watching this that we are sponsored by Trading 212. Our feedback is what it would have been anyway, but just to be clear that they are an organisation that provides us with sponsorship stuff. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.